Scott Wapner front and center this hour, the new quarter for stocks, with several major events looming. We're trading all of it with the investment committee. Joining me for the hour, Josh Brown, Stephanie Link, Carrie Firestone, Jim Lebenthal. We will show you the markets here. You know by now we're lower. We've been up for 5 straight months as we begin this new quarter. Iran, Israel, big story, obviously. Rates are down, dollar stronger, classic flight to safety on a day like this. Oil's higher. Steph, so we begin this quarter, as I said, with a lot to consider. Not to mention the news that we're all following today out of the Middle East. Rate cuts are coming, right? Powell says, though, they're going to be a little, maybe smaller than the market initially thought. Earnings, comps are going to be hard, mega cap especially. Election, who knows how messy that's going to be. How do we factor all of this into what you think is going to happen?
I think it's going to stay volatile. September was really weird and wacky, right? We were down 4% one week, up 4% another, up 1%, hit new highs. I mean, September lived up to the expectations of volatility. I don't think that changes in October for all the reasons that you just mentioned. But what was surprising to me yesterday was that the market sold off because Powell said he's not going to lower rates as quickly, or that was the message.
For a minute, you know what? Because then we closed well off of wherever we sold off to. I think it was like the market got to a point, it just took a few minutes, where, oh, okay, so stronger economy is more important than larger cuts.
Right. I mean, I take better growth and a little bit more inflation any day because that does help earnings. But here's the thing. So we're debating, are we in a soft landing or are we going to engineer a soft landing? Is Powell going to do it? We're already in a soft landing, guys, right? We're running 3.1% Atlanta Fed tracker. Inflation's at 2.2%. Prices paid for the ISMs today came in the lowest of the year. Jobs, JOLTS, revised higher, and also the number today was higher. So to me, I add all this stuff up, and I feel pretty good. We are getting a rate cut cycle. If it's slower, that's all right. If it's slower, it's because it's better growth, and that should help earnings. Yes, mega cap tech has very difficult comparisons. That's not really where I want to be. And you know that's not really where I am. I have a couple of them, but I think this broadening will absolutely continue. And I know we're going to talk about China. I think it's the real deal. I still like India. I think energy sets up pretty well for the end, between now and the end of the year. A lot of places to put your money.
Okay.
And I think we're going to rally into the end of after the election, though.
Okay. Josh Brown, how do you see things here? As I said, we have a lot to consider on this first day of the last quarter.
We don't want to read headlines about ballistic missiles, and we don't want to see more death and more destruction. And of course, that stuff is like very concerning on a human level. From an investment perspective, the market is not going to be caught unaware that there is turbulence in the Middle East. If you were waiting for peace in the Middle East before allocating assets, you would have been waiting about 5,000 years, and you'll probably be waiting another 5,000 years. So what we have to do here is understand that there are impacts on oil prices, for example, and we have to, of course, think about the big picture and how this affects investable assets. But in the end, interest rates and earnings are going to win out. They are the things that drive markets over the long term. And here's the good news. Interest rates are headed lower. We can debate the speed, but that's the trend. And earnings are headed higher. We could debate how much higher and for how much longer, but that's the trend. If you only know those two things, you know the two most important things that are going to impact how your portfolio does. It's not going to change. That's been the case. It will continue to be the case. And this is, I think, the job of professionals on Wall Street right now who are actually managing money and not trying to do the scariest tweet for the most likes.
You know, Carrie, it really sort of distills it all down like Tony Pasquarello at Goldman has done over the last several days that we mentioned yesterday. A lot of this other stuff is noisy, but it's not what's going to drive the train. Fed's cutting, economy's good. End of story. I mean, it's as simple as that for some. Is it as simple as that for you?
Well, I think if you look at the market as the 10 stocks that are 35% of the S&P that have driven everything for the last couple of years, and they're selling at 26 times next year's earnings, and you say they may have some problems over the next few quarters, and the 490 stocks in the S&P below that, those stocks are trading at about 18.5 times earnings. those are the stocks that have to produce the earnings, because we know it's going to be tough for the mega caps right now. And so our belief is that in the financials, the industrials, the healthcare names that we own, we're going to see decent numbers. They're going to start to pick up on the sales side. The earnings are going to come through. And that's where we believe you can continue to see the market go higher. We're not going to get that boost from the big cap names over the next few months. But you have interest rates coming down, and we're not in a recession, and we have decent jobs, and inflation has come down. So that's a good picture. We just can't have those other names disappoint and those sectors disappoint.
Can I jump in on that?
Yeah, go ahead.
All right, I want to say that Carrie is absolutely right. We can't lean on the 5 largest stocks to produce 3/4 of the earnings growth for very much longer. But the market has already processed that idea. And what you've seen in the third quarter, I believe, is in preparation for the next leg of this bull market. I want you to understand that in Q3 of this year, now that we're in the books, we have had the best quarter for stocks individually. And we've had in a very long time, one of the best quarters ever. 308 S&P 500 components beat the index. 328. Only 100 stocks went down, 400 went up. And when I say beat, I mean by a lot. The average S&P 500 stock over the last 90 days has returned over 9%. That's versus the index return of only 5%. So the market is saying that Carrie is right. And this is really important. If you spent the first half of this year whining and crying, it's all NVIDIA, it's all AI, well, guess what? Find a new thing to cry about, because that is not what's happening today. The average stock is trouncing the index, and that could continue into year end. It's the thing nobody has on their bingo card.
It's because the fact that utilities up 18% in the quarter, best in so 3. Real estate, Jimmy, up 16. Industrials up 11, record close yesterday. Materials up 9. Financials up 10. That's why Josh is able to tell the story that he was just telling, because those have outpaced things like technology, which was only up 1% in the quarter.
And I think it's very much supported by the fundamentals. So I love hearing my favorite growth investor to the right of me getting more value-y, and Josh sounds that way as well. But, you know, when I look at the sectors that you were just talking about, Scott, financials, industrials, materials, energy, for the large part, these stocks from an operational point of view have been doing very well for several years.
I didn't say energy, because that's down 3% in the quarter.
Okay. The larger point about the non-technology stock, you can't see Scott smiling, but he is.
Well, I mean,
the larger point, let me just make the point.
Let me make the point.
The larger point that I'm trying to make here is that the operational results for a lot of the non-technology stocks have really been fabulous for several years now. I'm talking about travel stocks. I'm talking about industrials. I'm talking about financials. But frankly, the valuations and the share price returns, even taking into account this year, have very much lagged those other stocks. So when we talk about the catch-up trade, it's not some sentiment, it's not some sort of consolation prize like, oh, we'll just throw some money at these other stocks, because there's fundamental reasons. These stocks are performing well, and this is very important, folks. They've been performing well for so long that they've managed to clean up their balance sheets across these sectors. You're seeing debt paydowns, you're seeing shares being repurchased, and it's finally starting to show up in the share price returns.
All right, we'll talk about one of those later on. Maybe you know what I'm alluding to, maybe you don't. But I'll bring it up later because you've made the case about it for some of those very reasons for a while, but we'll tease it out. Okay, so Steph, as I said, you know, financials up 10% in the quarter. They haven't traded all that well lately, right? Because, you know, the fact of the matter is that interest rates coming down is not really great for the banks, and we haven't seen a whole flood of capital markets activity, M&A, IPOs, and all of that, which would benefit some more than others. You have a couple of moves here that I want to discuss. So you sold Schwab. Why'd you do that?
Well, I sold Schwab so that I could have cash to buy other things that I like better in the short term. And also, I'm up about 16% in the name in the past year. It's been a very big disappointment for me this year, because I can't get out of their own way with regards to cash sorting in that situation. And so to me, at 21 times earnings, and now you have a CEO transition, which will take time. I just think that there are better places to put your money. I put it into Truist. I've been buying that for the past month and a half. It's now a top 5 position for me because interest rates coming down is actually positive for banks, especially if you have a steepening of the yield curve, which we are actually seeing. So maybe the rates are coming down a little slower, but they're coming down at the short end, and that's good for their bread and butter business. NII, net interest income, net interest margin, both benefit from a steeper yield curve, and that's 70% of their business. And the other part of the story that I like is that they've been going through a transition, a restructuring, cost cutting, focusing on growth businesses. That was 23 and into 24 story. 25, now they're going to focus on accelerating growth, profitability, and the stock trades at 0.98 times book value or 11 times earnings. And it's had a nice run, but I think that they're going to continue to gain market share. And as they do, I think the stock will continue to run.
So as we look at these other sectors, Jim, we have been able to hit record highs on a reasonably consistent basis. It's, they haven't been huge moves, but nonetheless, we've been climbing higher without tech leading. And many I know, including you, would suggest that's a good thing. Some people are complaining about, mega cap tech, look, it's falling behind. The point is okay, you've wanted performance from everything else. Now you're getting it. The question is, can it continue?
It's a legitimate question, and I think it depends on the 3 pillars that in my playbook have come through. You've got an economy that's hanging in there, and it's doing more than hanging in there. Steph, I'm going to just update us on Atlanta Fed. It's at 2.5% today, but still, it's a huge number. You've got China stimulating. That's absolutely encouraging for those other sectors that I mentioned before. And on top of that, Josh mentioned this, and it can't be underemphasized, the Fed is cutting. I don't care if it's going to be 25 or 50 basis points at the next meeting. Over 3 months, they will have cut by 100 basis points at least, and that's going to continue into next year. You have to think of all the things that buoys, including and starting foremost with the consumer, who we know at the lower end has been laboring under things like credit card debts and higher prices, but inflation is ameliorating. Credit card interest rates should be coming down, should help the banks, whether it's Truist for Stephanie or a Citigroup for me. There's just a lot of reasons to think that the rest of the market can do well. I want to point something out, and I'm just going to say it succinctly. I think you'll see a new high in NVIDIA before year end. I don't think there's anything wrong with the mega cap tech trade. I just think there are better returns to be held elsewhere.
In September, the trades tried to wake up a little bit, Carrie. Meta was up 8%. That had a really good quarter, far better than everything else. Apple was up 11, but otherwise it wasn't a good quarter at all for a lot of these mega cap names. Amazon's up 5 in September, down 3% in the quarter. NVIDIA is only up 1% in September, but down 1% for the quarter. It gives you the sort of uneven trade that those stocks have they started to take a back seat.
But that was okay for the market. The market is still basically at an all-time high. So the market can go up, and you don't have to have all of these stocks outperforming the market right now because there's enough buying under the surface. I would say that for the market to have to exist as an entity that's going forward on the back of 6 or 7 names is something that is unsustainable. It can last for a few years, and it has. Can it last for another few years? I don't really think so. At a certain point, everybody owns these stocks. Everybody that you come in contact with, and I mean everybody, says to you, you're in the investment business, what do you think about NVIDIA? And there are people who have no idea what NVIDIA is.
Don't you feel like that's cooled down a little bit?
Yes, but that's good. That is healthier for the market. It's like saying GameStop. It's like we should all own GameStop because we heard it from the person cutting our hair. I don't think so. So it's the same dynamic. You have to have something broader, and the professionals who are buying these stocks. We know the companies we're buying. It's not just the S&P index that's moving higher. It's other buying in addition to it.
I'm not suggesting we're not going to have NVIDIA earnings watch parties anymore because they're still going to be a thing, but it does feel like a little bit of the fervor about that has cooled a bit, which is good. You make the argument that's good. Now, on that note, I've got Amazon today removed from Barclays' top ideas list for the 4th quarter. Yes, they still have outperformed, but nonetheless, they just take it off the top ideas list. Goldman took Amazon from its conviction list. They still reiterate buy. Amazon was also removed from RBC's top 30 global ideas list. you want to take the first crack at this stuff?
Sure. It's up 20% year to date. When I was adding to it, it was trading at 13 times EBITDA. It's now at 15 times EBITDA. The long-term average is about 17 times. And I think it's had a nice run. I understand these moves. Take your gains when you have them. Though there's a lot of ways that this company can win. First and foremost, in retail, it's Walmart, Target, Costco, and Amazon. Those are the share takers. And Amazon also has a margin recovery story in North America. And they also have a third-party story in retail, going from 66% of GMV, gross merchandise value, to 77% by the end of this decade. So retail is really humming, and it's going to only get better, in my opinion. We know what's going on with cloud and AWS. That's actually seeing an acceleration, and I still think advertising business is underappreciated at this particular company. It's growing the fastest of the three segments, and also has the highest margins. So I kind of like this one, and I feel like you want to take some profits, I have no problem with that, but this is like a long-term story and a long-term hold for me.
I just want to focus in on one thing. Great synopsis there, but the retail. Let's talk about retail because the stock has languished since the last quarter when their projections for retail spending came in much less than expectations. Now think about what's going on in the economy right now. You've got inflation easing, you've got interest rates coming down, you've got employment hanging in there, all of which bodes well for retail. So I expect, Stephanie, when we get the next earnings report, that's where people are going to look, and I think we're going to be pleasantly surprised.
Well, you also have Prime Day. You also have Prime Day in this quarter versus last quarter. That should help retail as well.
I mean, I would just say,
No?
I'm sorry, but
Go ahead.
I have a hard time believing that the Fed cuts interest rates by 50 basis points and maybe they go 25 again.
Yeah.
And then the people who were having a hard time dealing with the rise in inflation and had already been tapped out are all of a sudden going to say, hey, you know what, let's go to the mall because Jay Powell just cut 50 basis points.
Your point is well made. But it's not just that. It's not just interest rates, which, by the way, I wouldn't undersell because credit card rates do come down immediately. Hang on, let me finish.
I understand
let me finish.
that, but
at the same time, you have inflation ameliorating. I mean, that's just a fact. We're going to get the CPI in a couple of weeks. I know it's a long time away, but it's likely to be on the headline 2.3. That's what the estimates are right now. Think about that, 2.3.
Okay, so prices are only going up by 2.3% now.
Wait, this matters. I wouldn't poo-poo it. Listen, we can disagree. We can disagree, but I'm telling you, I think it matters.
It's about jobs. It's about wages.
That's the next thing I was going to go to.
It's about personal income, personal savings, personal spending.
Average hourly earnings are greater than inflation.
Of course. And so, Walmart had a 4.2 comp. Costco had a 6% comp. People would die for those numbers. Even Target had a 2% comp. And Amazon grew retail 9%. Yeah, it was a little lower than expected, but these are numbers that are pretty healthy. And if the environment continues and the consumer still feels okay, which it apparently seems to be, then they will continue to spend. We are a nation of spenders.
So I have Microsoft today removed from the top 15 list at BMO. You decide, you read a report one day to the next on what the iPhone 16 is doing. Is demand good? Is it bad? Is it weak? Is it strong? Is it this, that, or the other? The stock's been doing pretty well, even in the face of some of this. Josh, do you make anything of the commentary on Apple? How would you view it? Again, it's only up 1% in September. It did have a great quarter, up 11% in Q3.
We are following the script, Judge. We're doing the same thing that we do every time. We're getting the report from Asia that a certain supplier is whispering that there have been production cuts. This is every time they release anything. Then we're getting the analysts saying, wait, actually, no, you don't understand. It's going to be a slow burn. Then we have other analysts coming out and saying demand is weak. And then a week later, it's going to be, oh, wait, actually, demand is stronger than we expect. The rhythm of this, I could almost script it for you. We're doing this, 12 years. The thing to understand about the upgrade cycle for Apple, it doesn't matter whether or not the phone is revolutionary or not. What matters is the average age of the fleet, so to speak. The global fleet of iPhones is severely old relative to prior cycles, and that is what's going to feed into the replacement cycle, and I think it's going to be fine. I did my own channel check. I went to the Verizon store on Sunrise Highway, and the guy told me, we don't have any phones until early November, so you're better off ordering it directly from Apple, and we'll just get you set up. I said, is that usual? He said, no, it's not usual. Usually, we have boxes and boxes of phones, but people are buying them. So I don't know. Everyone has an anecdote. There's mine. Better to just let time pass and let's see what actually happens.
You actually have a, outside of the mega caps, you do have the filing of an IPO by a chip maker. It's Cerebras. Maybe they'll take on NVIDIA. The latest funding round valued that company $4 billion. Backers include Sam Altman, Code2, Altimeter, Benchmark, plans to go public in the NASDAQ. I don't know. B of A today says the highest owned semis still are relatively underweight, if you want to believe that. Steph, what do you make of that? That the highest owned semis are still relatively underweight.
I know I am.
Well, yeah, but that's what happens when you're at 8% of the S&P, or 6%, 6.5% with NVIDIA and whatever it is, 2% with Broadcom. That's 10% in two names, close to. I mean, you can't be overweight. Otherwise, you only have 6 stocks in your portfolio.
So that's not. That stat is not telling of
Not relevant.
an opportunity that exists. That's how it's being painted.
Yeah.
I think it's interesting, actually. I mean, I've been adding to Broadcom and Lam Research on the kind of the declines, if you will. They're volatile stocks. You get a look every once in a while, right? So I think that Broadcom, to me, is just the one that I wanted to bet on versus NVIDIA. I mean, I'm still up quite a bit in it. It hasn't done as well, but I think you could still make a lot of money. I mean, why I like Broadcom only because that their AI business certainly is growing 3 to 4-fold, right? But they also have VMware, and that actually changes the story completely in terms of software, in terms of margins and free cash flow. And so to me, that's the one I'm betting on. But I kind of like the fact that if that is in fact true that people are underweight semis, that's not a bad sign.
Well, it's mostly because they're underweight NVIDIA, and it's like saying people are underweight Apple. Almost everybody is, or underweight Microsoft, because again, very, very hard. I get that, but if you added up everything, what would it be now? I don't know, 14% of the S&P. I don't know. It's a big number. It's hard to be overweight.
All right, so let's take a quick break, and when we come back, we're going to do our calls of the day. We got an interesting battle coming up on General Motors. We certainly do. GE Healthcare, Thermo, Health Equity, CarMax, Shark Ninja. We got all those trades coming up next. Okay, welcome back. Let's do some calls of the day. General Motors today. Price target goes to 61 from 53. Reiterated buy at Goldman Sachs. Bring it up because yesterday it was reiterated sell by Sarat Sethi on our program, who said he sold it last week, and I want you to listen to his explanation for why.
It's been a horrible investment. The consumer's slowing. You've got a huge amount of supply of autos. It's not just GM. It's Ford. It's everybody else is coming there. I just think you've got peak earnings there, and they're reinvesting so much money into products we don't know if they have a return on investment.
Okay, I wanted you to react to that. He's owned it for years. You know that. He's defended it at numerous turns, and now just said, I've had enough.
Okay, he's had enough. It's up 38% in a year, and he may have just wanted to say, look, after several years before that of not doing well, I'd rather ring the bell right now and take the bird in the hand. I can understand that. I have to tell you just straight up, and everybody needs to hear me on this, I really don't care what it's done over the last 1, 5, or 10 years. I know a lot of people like to look at the historical performance and say that's what's going to be going forward. I do not believe that.
You don't care what it's done for the last 1, 5, or 10 years?
I don't. It tells me nothing about where it's going
for the enjoyment
forward.
Of saying you own General Motors stock?
It tells me nothing about where it's going forward. I have to make a decision today to buy, sell, or hold this stock. What it's done tells me nothing about what it's going to do. What tells me what it's going to do is releases like you got today, okay, in which it said that the average transaction price for the third quarter is in line with the second quarter. This is very important, and it may seem like I'm focusing on one detail, but I want to point out at the last quarter, the second quarter earnings report, it was a blowout report. Stock went down. Why? Because people started projecting that average transaction prices were going down. They're not. They're staying flat. The volume came in better than expected. EV sales came in better than expected. So the investments that they're making are starting to pay off. And all this for a stock that trades under 5 times earnings. Look, people can disagree with me. That's fine. People can have different methodology than me. That's fine. But I do not care what it's done over the last 1, 5, or 10 years. It tells me nothing about what it's going to do going forward. I'm holding it because I see better gains than the S&P 500 going forward. If I'm wrong, and we'll discuss it then.
Okay. GE Healthcare. Nothing more needs to be said.
I was like lying.
Wow.
That's it?
Hey, you do you, man. I mean, you do you.
Like, okay.
you tell our viewers what floats your boat, and they make their own decisions.
Moving on.
That's what we do. GE Healthcare, reiterated top pick and a buy. $103 is the price target at Citi. Steph.
Yeah, I think that the third quarter is going to be the low for organic growth at 1%. I think they can get back to mid-single digit growth. Operating margins can expand between this year and next year, 200 basis points. You have very easy comparisons ahead. Inflation coming down helps their cost structure quite a bit. And China is 13% of their total revenue. So it's had a nice run. It's up 18% year to date, up 35% in the past year. Good split from GE so far, but I think there's more to go.
All right, Thermo Fisher, overweight, $680, price target at Stevens. They have unparalleled reach into biopharma customers with a broad portfolio of offerings that support customers from drug discovery, clinical development, and commercial production. That's from the note, Carrie. You own the stock.
Yeah, and all that's true. What's happened with the company in the fundamentals is after COVID, where they had billions of dollars of sales because of COVID testing, they had this low where the COVID testing stopped and it wasn't replaced because there was a slowdown because of interest rates and spending for biotech in particular. Well, now interest rates are coming down. We're seeing a resumption of spending, and Thermo is the place to do it. They provide for all of the different operators in the whole biotechnology and pharmaceutical industry, and that's testing and equipment and all types of fundamental processing that you need behind the scenes in drug development. So yes, we think it's a great stock, and next year we believe that sales will begin to accelerate again.
What about Health Equity? RBC's top idea list for the fourth quarter. $100 is the target. Compelling opportunity as valuation is recently compressed.
Yeah, that's true. So Health Equity is the largest of the health savings account companies. And this is a growing field where employers offer this to their employees, and your money accumulates there, and you're not paying taxes on it. It's like a 401k plan. So we believe that if employment stays strong, interest rates are not coming down to zero, but they're coming down a little bit. That's fine. As long as the economy keeps growing and more companies are part of this process, that's good for Health Equity earnings and shares.
So what do you think about CarMax, which JP Morgan has added to its focus list as a short?
Yeah,
as
great.
a short. They're underweight. The target's 65. Recent results continue to show a lack of market share recovery when peers like Carvana are rapidly gaining share at 2 times unit economics.
Yeah, okay, so this has not been a great stock. Let's admit that. However, what we saw in the last quarter is an improvement. We've begun to see used car prices come down. They're now 15% lower than they were at the peak during the pandemic. Car prices went way up and you couldn't buy a used car. That started to happen for them. Interest rates are coming down. That is a big factor in the auto sales market. So you have lower car prices, lower interest rates. You have a better environment economically than we've had for years in terms of finding a car. And we think that they have the best on-premises and online platform in which to purchase a used car, and that will be good for them.
Josh, you're not in Shark Ninja anymore. Got stopped out in mid-July, but it was initiated, outperformed today, $120 at Oppenheimer. Year to date, I've got it up more than 100%.
Yeah, this is an incredible story. Most of the people watching are familiar with either the Ninja blender or the Shark vacuum cleaner. I think we're on our second Shark vacuum cleaner at home, and it's just the superior product. And the company's got this history of being really good at figuring out what the buyer of these types of everyday appliances really wants, and then engineering to the point where it's the only choice once you start using it. So I missed out on the run here. This is the danger of being too risk averse, sometimes having a stop loss that's a little bit too close to the market price. If you get stopped out and you were right all along, you get to watch other people make money. So that's the story here with me.
All right. Up next, Trade School is in session. On the 60-40 portfolio, it's traditionally been a safe bet, but should you rethink the set it and forget it strategy? Been some interesting moves this year. We will discuss next. For Trade School, because over the last year plus, we've had many conversations on this desk about the future of the 60-40 portfolio, something we all know well. A lot of suggestions that it was dead, okay? Well, it had come back in a big way. The AR, which is the iShares Core Growth Allocation ETF that represents the 60-40, hit an all-time high on Friday. Barclays says the 60/40 portfolio recorded its best quarter this year, okay, with both equities and bonds up in Q3. Now, Barron's says the 60/40 portfolio worked well for over a century. It's flashing a warning now. What do we think about this tried and true investment strategy, Josh, that our viewers have heard about for years, and then we're told it was dead? What about now?
It does better than other periods of time, which is part of the risk of investing, and that's why you get paid for the risk that you take. I don't think the suggestion that the 60/40 is dead is ever useful. Of course, it had a terrible year in 2022, which is why it's worked wonderfully in 23 and so far the first half of this year. GMO is using a valuation-based framework to try to figure out which asset classes are worth investing in and which ones aren't. Unfortunately, and they would admit this, and I know Jeremy Grantham, he's been on my podcast, these forecasts have not been helpful for investors. The last 7-year forecast from 2016 that just had its period ended was particularly horrific. They got it 100% backwards. They told you to buy emerging market stocks in timber and be underweight U.S. large caps. Of course, U.S. large caps went on to do almost 200% returns. The NASDAQ did over 300% returns. EM has been effectively flat. Timber has been worse. It's really important that we understand that although valuation is important, the world changes. The last thing I want to say on 60/40 here is that part of the reason this works is because the bond yields are helping you. We had a period of time where yields were really low. They were like 1% or lower. And as a result, you needed to earn an 11% return from your stocks in order to get that total nominal return of 7%. The good news is stocks did 14% average annual returns while bond yields were close to zero, and that's why it worked. Now, bond yields are 4%. You only need a 9% nominal return on stocks in order to get that blended 7% that you're hoping the 60/40 can deliver. So the bonds are going to kick in more of the help, even though stocks are more highly valued in the short term. That's why the portfolio works over long stretches of time. That's why financial advisors employ it. It doesn't mean always being right. It means being right much more than you're wrong and never having to say you're sorry to a client who missed out on the opportunity to compound.
Jimmy.
Yeah, I totally agree with what he's saying, and I think perspective here matters. Some people may have the wrong expectations because the S&P 500 has been up 20% over each of the last 2 years. That is not likely to continue, but as Josh just pointed out, if you get the historical average return from the S&P 500 of 9% and the 4%, maybe even 5% from investment-grade corporate bonds, you're sitting pretty. And I also want to point this out. On the bonds, after inflation, you've got a real return. I mean, inflation, depending on how you measure it, 2 to 3%, 4 to 5% is tautologically higher. So it is a matter of perspective here. It's also a matter of time frame. Any quarter, you might see yields go up and bonds go down, and certainly the boo birds will come out and say that the portfolio is dead. I don't think so. I think over the long run, it absolutely will work.
All right. We want to welcome you back and go to our Contessa Brewer, who has breaking news for us. Contessa?
Scott, we are now seeing missiles entering the airspace above Tel Aviv. The Israeli Defense Force has confirmed Iranian missiles have been launched toward Tel Aviv. You are hearing those air sirens now, warning the citizens of Tel Aviv that there are incoming forces. We are told that Iran is expected to launch 240 to 250 missiles in 2 waves at 4 different targets in Israel, including Mossad headquarters. This would be outside of Tel Aviv, and 3 air bases. That's according to 2 sources, an Israeli source and a senior U.S. administration official to ABC News. We know the president has convened a meeting with Vice President Kamala Harris and the national security team to talk about Iranian plans to launch an attack against Israel. They have already warned Iran there will be severe consequences for launching this airstrike toward Israel. Israel's military says that the civilians are in bomb shelters as these rockets are now coming in. I just want to take a moment here so that you can hear the situation unfolding as we see these missiles coming in from the sky. It's a momentous day in the Middle East and the latest escalation in this back and forth. We know that that Israel has just launched what it calls precision strikes outside of Beirut, that there have been ground forces that have crossed into Lebanon to target Hezbollah militants. And Hezbollah is, of course, backed by Iran. Now you're seeing Iran's reaction to Israel. Israel has said it is ready to defend against these incoming missile attacks. But again, this is the news as we're seeing it right now, Scott. The missiles coming in above the airspace in Tel Aviv, the latest escalation in what has been Israel's targeting of terrorists who have been, as we know, targeting Israel as well. And they're coming in. Scott, we continue to monitor the situation. We'll bring you the news as it happens here at CNBC headquarters.
Contessa, we're watching it show itself in the market, too, depending on which asset class you look at, whether it's yields down because of a flight to safety, the dollar playing into that role. That's at the highs of the day on an intraday basis. That's the dollar index. You can take a look at oil, too, which is up near 5%. WTI, all of this, of course, reacting to the news that Contessa was bringing us. Already an area on edge, but now the missiles are heading into Tel Aviv, as she just showed us on those live pictures. We'll take a quick break. I should point out, too, NASDAQ's now down 2%. That's a loss of 355 points. Dow's down about 250. That's 2/3 of 1%, but the NASDAQ is by far the hardest hit of the majors today. Final trades are coming up next. All right, welcome back. We'll do final trades in just a second. I do want to talk about Nike, though. They report today. Obviously, they have a new CEO. I'm surprised. I don't know. Part of me says, hey, Stephanie Link buys this on the news that Tano's out because she likes a good turnaround story. Although I know you have issues with the valuation, and you have. You got to be a little quick, but what's your answer here?
So Hoka and On grew revenues 25 and 29% their last quarter. Nike's going to fall 10% this quarter. I don't think the quarter really matters. I think it's de-risked. It's all about guidance. Do they pull it or not? But market share losses are significant. It's going to take a long time for this turnaround to work, in my opinion.
Too long for a Stephanie Link turnaround story?
Maybe I'll wait a quarter or two. I'm not going to rule it out, but not now.
Okay. Josh Brown, what do you got for finals?
Oil stocks are my hedge against Iranian terrorism. IEO.
Thank you. Farmer Jim.
Not just because Josh said that, but ExxonMobil is 3% away from an all-time high. It's actually having a great year.
Here.
Chemed, CHE, one of its divisions, will help people hurt by Helene with their plumbing and water systems.
Thank you, Steph.
China play is Las Vegas Sands.
Okay, good stuff. I'll see you on the bell. Thanks, everybody. We'll track that final hour of trade. The exchanges now.